Today at InvestTalk, we compare flipping versus long-term rental real estate investing. Then we look at the market moves ahead of tomorrow's election. I answer questions about SMCI, Sprouts Farmers Market, SoFi, and more. And at the end, I look at which Trump trades make sense.
This is InvestTalk, independent thinking, shared success.
Now, my focus point today concerns flipping versus renting. And I love this topic because real estate investing is something a lot of people see as their road to riches and financial independence. And I certainly think for certain people, it can work. But for a lot of people, they don't go into it with their eyes wide open. They think it's easy. They think they call it mailbox money, that it's just you buy a house, you rent it, and suddenly, your money rolls in and you're good to go. But it's a lot more complex than that, especially when you're looking at two different types of strategies, flipping a house versus renting. And, the simple answer to which one is right for you, it depends entirely on your goals. Flipping a house usually takes around 6 months on average, but can take a lot more and a lot more time, a lot more of your time. But you can make a lot more money just in one deal if you do it right. Many people can earn, 50+% on their investment in just a short period of time. Now, there's some pros and cons to that, which we'll get into here now. Now, flipping is not really an investment. It's really more like a job, because managing and overseeing the project, even though if you're not doing the work yourself, usually you're hiring contractors, you're coordinating everything, getting the plans approved with the city, you're buying insurance, you're borrowing money, typically, setting up a timeline and a budget, and it's a big endeavor. And so it really should be considered more of a business rather than an investment. And before you ever get into that, you need to learn everything you can about each part of the business. Where the headaches are, talk to people that have done this before, what they've learned, where they've seen major things go wrong. Because what happens when a flip goes wrong is you can actually lose a lot of money, and you've gone through a lot of stress, a lot of work, and it can go awry really quick. Especially if you buy when the market is declining, meaning, you're fighting against time, you're fighting an uphill battle against a market that is maybe going from a buyer's market from a seller's market to a buyer's market, right? And suddenly, once you bought during the seller's market and you're trying to sell during a buyer's market, that can be a challenge, okay? And then not to mention, contractors that can stiff you, the city that can hold things up, et cetera. So there's a lot that goes into it. Now, the pros are, though, that, it's quick return on your money. And once again, there can be bumps in the road, but it can be, like I said, 6 months on average. That could go longer, it could be a little shorter, but a lot of people like that quick turnover and big returns. Another pro is that once you're done, you move on. You don't have to worry about finding tenants, collecting rent checks, property management, etc. You don't need to be a landlord. Now, the cons are it's inconsistent. Some projects may be big winners, others not. Others might be losers, okay? So it's not really consistent income. And what about all the other things you could do, the other career that you could get into? Because really flipping a house is a full-time job. And then taxes. Especially if you're not owning it for longer than a year, you're doing like 6-month projects, that is taxed at typically the highest income tax rate, okay? Let's talk about the pros and cons of long-term buy and hold renting. Now, the first pro is simply it's kind of passive income, right? If you get injured, you're unable to work, et cetera, you still receive your rental income. Now, I kind of balk at the passive income moniker of buy and hold renting because it's more like a part-time job. So I'll get to that in the cons. But for most people, at least you can hire property managers, et cetera, and you can release a lot of the burden. But still, it's a lot easier on the time and the body when you are a buy and hold long-term renter. Now, the second pro is over time, it's a inflation hedge. Okay, it likely will go up over time, especially in an inflationary environment. You will see long-term price appreciation. And then once you do sell it, you can capture those long-term capital gains at that 15 or 20% rate, depending on your income for the year, what the tax situation is. But that's a lot better than the 25 to 43% that you're going to pay when you're flipping a house short term. You can also write off a lot of expenses, repairs, maintenance, things to gas to drive to and from the property, for example, cost of a property manager if you do hire one, and the list goes on and on. Finding ways to really find expenses that you can write off on that investment, as well as, most importantly, depreciation. Obviously, Trump loves depreciation. It's a big part of real estate investing, and being able to take that depreciation, which is a non-cash transaction, but will save you thousands of dollars a year on taxes. Now, once again, you do recapture. It's called it's a depreciation recapture when you do sell that property, but you can do things like 1031 exchanges. You can do deferred sales trusts, et cetera, that can help mitigate that issue. Now, the con. Risk of vacancy. Obviously, you could have tenants that don't pay, tenants that move out, and then you have trouble filling that property for a number of months, as well as getting the cost of getting that property back up to speed for the new renters. That can be expensive as well. And you add on top of that the maintenance costs. And if you are trying to manage that property yourself, it's probably a part-time job. That's why I don't really like it to say it's a passive income. It's still some activity. And you can hire a property manager, but that eats into your overall cash flow and returns. And so ideally, you don't really want to have to do that if you don't have to. So that's a con. And then I think those are the two. Yeah, those are the two main cons there: vacancies and that property management, and sudden expenses. Think of it: AC goes out, a flood, etc., and that can be a big challenge. So these are the pros and cons, and you have to go into each endeavor with your eyes wide open.
Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates. Let's take a quick look at the markets today. You had the S&P 500 that was down 16 points. So let's call it 0.3% or so. Yeah, 0.28% exactly. The broad NYSE, that was barely down, and down about less than 0.5%. Excuse me, that's what it was down. You have the MOVE index. That was kind of the interesting one. That continues to move higher. 136 on the MOVE index. This is starting to creep up close to that 150 range. When it gets to 150, this is a problem for the broader market, most importantly for the treasury market. And this will require the Fed to step in and probably ease more aggressively. So, the big question is, why is the treasury market suddenly becoming a bit dysfunctional? Is it worries about inflation and spending going forward? Is it worries about the debt issuance going forward in the first quarter, for example? It's one of the reasons I think the Treasury is focusing on the short end of the Treasury curve. Is it because of the reverse repo drawing down eventually to zero? That's kind of a wonky technical term behind the scenes that's been kind of propping up the demand for treasuries. So there's a lot to this, but it's something that I'm continuing to watch, and definitely is the most worrying part of what's happening in the market right now. Now, once again, I don't want to freak everybody out, but that's just, I'm just calling it like it is. The first, I think, real worry sign that I've seen in a while. Okay, now after the election, after the Fed announcement, that certainly could change. It could drop back to 110, 120, and now it's off the radar. But something I will continue to watch. You have the Nasdaq down 0.3% as well, so that was definitely weaker than the broader market. You had Bitcoin down nearly 3% on the day, Tesla down about 2.5%, or some other big movers. Amazon down 1%. after the big move up on Friday. And I think that's Microsoft down a little bit. Yeah, growth certainly underperformed on the day, and large cap certainly underperformed overall. So tomorrow, you might think there's going to be a lot of market gyrations. Frankly, probably not. You're not going to get a lot of understanding of what the election outcome will be pretty much until Wednesday morning. And so tomorrow, I expect kind of a holding pattern overall. Although you could see some front running of certain trades here and there, but overall, I expect a holding pattern. Gold did tick up a little bit on the day, and you had the dollar tick down a bit on the day, although closing near the highs. So kind of rallied throughout the day. So that was the market today, and I think fireworks will happen Wednesday and Thursday during the Fed meeting.
Hi, Justin or Lou. I'm calling about a fairly new ETF, ticker symbol FCTE. I don't have much data on it, but I heard about it through a friend. I was wondering if you could take a look and if you could pull it up in your system and let me know if you think it's a good investment. Thank you. Bye.
All right. Interesting one here. This is let's see. What's the name of this one? SMI 314 full cycle trend. I have not heard of this one. Full cycle trend. It's hard for me to give you an answer on this because I would really have to dig into what this strategy is. Obviously, the caller didn't give me much to work with there. And we take these, I don't prep for these calls. Now, it is recently, it is new. It came out in July. Let me look at the holdings because at least I can get some sense of what they're doing. It's 100% U.S. equities. And it looks like it's about 20% technology, 15% consumer defensive, 15% healthcare, 0 energy, 0 basic materials, 15% consumer. I'm assuming this has something to do with when you say full cycle trend, they're looking at maybe the business cycle and adjusting the portfolio accordingly and buying companies that maybe are aligned with a particular trend. It seems like more of a trend following type of strategy. Honestly, though, I don't know enough about it. I wish I could give you some deeper answers, but being so new and how little time I have to really dig into it, I can't really say up or down on this. But I like the idea, at least, of if it's executed well, full cycle, right? And we do this at KPP where we focus on the business cycle, lean on the sectors that are likely to do well based on the growth of the market, growth of the economy, growth of inflation or lack thereof. And based on those factors, you typically can see certain slices of the market outperform or underperform. For example, if the economy is reaccelerating, inflation's reaccelerating, what happens with interest rates? Interest rates tend to go up. And therefore, bond proxies like utilities tend to go down and vice versa, right? So in an environment where bonds are doing well, utilities should do well also, and vice versa. And so those are the type of decisions we make for clients. And maybe this is what their crux of their positioning is as well. Now, they don't have any utilities right now. They don't have energy. They don't have basic materials. What worries me, though, is that, yes, energy hasn't been doing well, but basic materials have been doing great. And so why do they have no basic materials? I would really have to understand the strategy deeper. But thanks for the call. And maybe you can email me and give me a rundown of the strategy. I can give you, my opinion, whether it's up or down. I hope you all been telling your friends that our InvestTalk audio podcasts are available in video form over on our YouTube channel. And it seems like every day we get questions submitted via the comment section. So let's tackle one of those right now. Muck02 says, SMCI has plummeted due to its accounting irregularities. At this valuation, would you think about investing in SMCI? This is one of those great lessons that everybody should learn. This is why we talk about investing in companies based on the reality and not on the hype. And I always thought SMCI was one of the weakest within the space just because it's smaller and so niche and didn't really have a great track record of good leadership, et cetera. And you're seeing that now. This peaked out at over $122 per share. Now it's down to $26 per share. Now, what I will say is it is getting down to levels that I think a lot of these risks are priced in. I'll tell you what I did. in my personal account, I actually sold some 17 strike puts. The 26 now. I did that last week. I believe I did it on Friday. Got some nice premium there. And so, I think it's in the zone of good valuation. But ultimately, it depends on, how bad those accounting irregularities are. We probably won't get a resolution to that in the short term. So I feel like 17 between here and 17 is pretty good support. And so that's why I sold those 17 strike puts. And I do think it's pretty good risk versus reward here after this fall. Thanks for the question. Let's go take a live call talking to Sid in North Carolina looking at PLBY.
Hi, Justin. Thank you for your time and taking the call. Yes, I do have this in my portfolio. Picked up some time. So currently I'm at loss. But I saw that lately there was some moment and it was almost a penny, but 60, 70 cents, and now it is $1.30 something. Do you think this has some spark left, or should I sell it off and take loss? What's your input? Thank you so much for your time.
Well, this is a difficult one because PLBY has a fantastic brand. It's just been horribly managed since really throughout the years from a business perspective. And, they did just enter a strategic partnership with Byborg Group. And, I think it's one of those things that, who knows, it gives them some cash flow and I think keeps them out of bankruptcy for a period of time because of this 15-year agreement gives them $20 million in annual payments to PLBY. And for 15 years, so that's $300 million going forward that they can probably borrow against and do some things to kind of keep their business afloat in the near term and right size it. So I think this gives them a little more runway to get back to better management of a brand that's one of the most widely known. But it's still very high risk. This gives them, like I said, just more runway. It doesn't give them guarantee that the management will execute. If you want to take the loss and you have better opportunities out there for the money, then I would sell it. If you don't feel like you have a better place to do it, you don't need the loss or whatever, then maybe you bet on it. But it's still high risk, like I said. So I don't have an answer one way or the other. It just depends on your risk tolerance level and your opportunity costs elsewhere. Thanks for the call.
Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox.
Now let's keep things moving and pivot back to the InvestTalk Voice Bank. It never closes at 888-99 chart.
Hi, my name is Duncan Forbes, calling for a quick question on stock ticker SoFi, SOFI. It's a financial stock, fintech actually, and their recent earnings came out on October 28th, and it seemed everything was good. Return on equity increased, all their products seemed increased too. I got this information from a growth investor podcast, and I just wanted to see your two thoughts on it. I know it's still a risky business, but looking forward to your advice. Have a great day. Bye.
All right, looking at SoFi Technologies, and first off, I'm always a bit weary when companies sponsor big sports stadiums. Now, it doesn't always have to be the case, but just think throughout the years. It's been, especially if it's a newer company, hasn't been around a long time, and SoFi hasn't. It was started in 2011, so it's been around 13 years. So you're talking a little over a decade in. They're sponsoring one of the largest stadiums in the country, SoFi Field here in Los Angeles. And that worries me. And then you get into its financials, and its free cash flow is negative. The return equity has turned positive. That's true, but it's only 3.6%. Head in the right direction. I'll agree with that. But if you look at things like free cash flow, it remains very negative, even though it is improving. So a lot of things are improving, headed towards nice profitability this year. And it, over the past, call it four quarters, it earns 10 cents a share. But it's a almost $11 stock. So you're talking about over 100 times earnings, even though they go based on forward-looking earnings. So it's to earn 27 cents a share next year. You're talking about 40 times earnings. That's still very expensive. Now, the good thing is it has a good balance sheet, but its shares outstanding continues to march higher. Back in 2021, it had 794 million shares outstanding. Now it has nearly 1.1 billion. So it's diluted shareholders consistently throughout the last few years, and I don't like that either. Now, from a technical perspective, it's on an uptrend. Okay, it has moved positively, and I will give it kind of a thumbs up technically. Okay, but it's extremely high risk. It's still extremely expensive, and it's going to have to continue to grow very consistently. Now, for everyone else out there, if you don't know what SoFi does, I talked about it sponsoring the stadium, but it's a financial service company. It's known for student loan refinancing business mainly, but it also offers personal loans, credit cards, mortgages, investment accounts, etc. So it's more of a fintech company and a way to access a lot of younger people through refinancing those student loans, and it gives them access to help them with other products. Okay. Now, the good thing is the consumer is in good shape generally, and I think that's helping SoFi. But I think it's too expensive even at this growth level, and that's why I'd say it's still extremely high risk. But if you want to play the momentum, go ahead. I just don't think it's good value. Now we have some time, so let me drop another question from our InvestTalk YouTube channel. Adrian Vasquez says, what are your thoughts on SPLV as a long-term set it and forget it ETF? Thank you, and RIP Steve. Appreciate those sentiments. Now, SPLV, this is one of those stocks or one of those ETFs that I have trouble with the name. Okay. Now it's the Invesco S&P 500 low volatility ETF. Low volatility ETF. So what it makes people believe is that you are investing in companies that have low volatility, that it's low risk. When in reality, these are still equities at the end of the day. And it can still drop dramatically. Okay. So if I go to a monthly chart, I'm going to zoom back out here. Now, this did come out in 2011, so post-financial crisis. But let's just look at the COVID crisis. Okay. This fell from a high of about $62 down to a low of $38 in the span of 2 months. Okay, so that's a big drop. Does that seem like low volatility to you? It's over a 30% drop in 2 months. For most people, they wouldn't consider that low volatility. So that's the first thing you have to do, is you have to think, okay, are you getting what the title says? And my answer is no, not really. You're still getting equity volatility. And you have to understand that. Now, if you look at the construction of the portfolio, it's a large cap value fund. Now, I like value. I like leaning on the value side of the market right now. So from that standpoint, I give it a thumbs up. Technology, you're only at 8%. You're at 22% financial services, 12% industrials, consumer defensive, 14%, utilities, 12%. Now, utilities are low volatility, but long-term, they have lower returns. Okay. So that's my issue here, is that if you're just going based on low volatility, you're going to tend to buy companies that have lower long-term returns like utilities. So is this a better risk-adjusted ETF than, say, the S&P in general? Yeah, I do like that because I like the structure of the sector breakdown better than the S&P. But I think you can do better by just buying, say, a large cap value ETF that's going to have similar characteristics, but not 12% in utilities, for example. So don't get caught up in the name and think that's exactly what you're getting. You're getting this safe investment. No, it's not safe. It's still equities. Okay. And I'll go look at Vanguard Value ETF, ETV. I'm not saying you go buy that one, but something similar. Utility is only 5% of that portfolio. Okay. Industrials are 13, so a little bit better there. So I think that is a better way to gain access to large cap value stocks than the S&P low volatility ETF. Okay. Thanks for the call. Now let's touch on some of the Trump trades. There's been a lot over the past few weeks. You've seen Bitcoin, gold, and the dollar rally, DJT rally, treasuries sell off along with the Mexican peso. Healthcare and prison stocks have gone up, and clean energy stocks have gone down. European defense stocks have gone up, and bank stocks have gone up as well. So let's dig into a few of these and see which ones make sense. Now, the first one, the biggest one, is DJT. And obviously, in some ways, it would be a winner if Trump wins. But look at the business. It's not really a business. They do have a lot of cash, but sales last year, get this, $836,900. Yeah, you read that right. Less than $1 million in sales, and its current market value is $6 billion, 6.1. That's more than 3,000 times annual sales. Now, if I see anything north of 10 times sales, that's usually pretty expensive. This is 3,000 times sales. So this is a pure speculative vehicle. That is it. This is not at any valuation that makes any sense at all. Okay. Now, the next one would be the prison stocks. Geo Group, Core Civic, et cetera. They're up as of late. And this one makes sense because obviously Trump wants to do some mass deportation. Obviously, those people will have to go into prisons for a short period of time before they are deported. So that one makes sense. And also, Trump is just going to be friendlier to the private prison industry. Now, the dollar is up, bond yields are up, and gold is up. And frankly, I think some of that makes sense. Now, I think the dollar up is based on a stronger economy, but JD Vance, his vice president, has talked about a weaker dollar so that it helps the manufacturing industry. So I actually think the Trump will find ways to weaken the dollar. Bond yields are up, and I think that makes sense because a weaker dollar and more importing of goods, reshoring of goods, manufacturing, that will create inflation. Obviously, tariffs would create inflation, and gold is up in sympathy as well. So of those three, I think the dollar being up doesn't make quite as much sense. Now, the peso has been down, but a lot of this, I think, has to do with some of their issues around their judiciary, remaking of the judiciary in Mexico, and there's been some volatility there. So I think it has more to do with that, because I don't see Mexico really being hurt too much by a reshoring and manufacturing, mainly because there's a lot of business that will still need to be done. A lot of products that still need to be produced in places like Mexico, and think widgets, small parts of full products that will need to be made there and imported here to the United States. So I actually think Mexico will benefit from a Trump presidency. So I don't see that as making sense. Bitcoin's up, but if you look at its correlation with the odds of Trump winning, it's been kind of all over the board. So it doesn't really have a clear indication one way or the other, despite Trump being friendly to the crypto industry. Healthcare stocks have fallen about 3%. And I think that does make sense. Why? Because if you look at RFK maybe coming in and trying to put some more regulation around the process of getting drugs approved, and maybe pushing against drug prices going up, et cetera, finding alternatives to your mainstream drugs as well. I think that all kind of makes sense. On top of that, obviously, he wants to get rid of Obamacare, and I think the healthcare companies certainly had a big hand in writing Obamacare and profiting from that as well. European defense stocks, they should, you would imagine, go up because Trump is wanting to pull support for European defense, and they want to beef up their defense. But what's interesting is that they've been trading in opposite directions. They've been going down when Trump odds have been going up, and vice versa. And so I thought that was interesting as well. Now, the one that makes the most sense to me, bank stocks going up. Lower regulation would help bank stocks both large and small. And obviously a strong economy would help them as well. But I think it's more about less regulation. So It's pretty interesting to see the way the market moves. And remember, the market doesn't always get these things right. It can go one way, and then ultimately the new administration, whether that is Trump or Kamala, can surprise and bring somebody in that has different views, or maybe not as strong as views as the market had expected. And so it'll be very interesting to see how these markets move, but don't just take them on face value. You really have to dig into them and see what makes sense going forward.
Stay informed and stay empowered by visiting investtalk.com today.
Gentlemen, my name is Lauren. I'm from Wilmington, Delaware, and I have a question about AIT, Applied Industrial Technology. It looks very good. I have purchased some, and I really want to buy more, but I'd like to get your opinion of this stock before I make any move. I'll listen on the podcast, and I thank you very much.
Well, thank you for the call. And you are hitting on a company that is actually on our watch list over at KPP. It is a name that we are interested in purchasing. Now, we have not fired on it, mainly because we found other names that we like slightly better. But we do really like this name, mainly because of its consistent profitability. Usually return equity is hanging around the 20% range. Now it's at 23%. So we really like that. Return on invested capital around 17%. And that's also typically hangs around the mid-teens. It has pretty much no debt on its balance sheet. So we love that. $406 million in free cash flow on a market cap of about $9 billion. So, not a huge free cash flow yield, but about 4.5% or so. It has a dividend, but it's not big, only about 2/3 of 1%. But it consistently takes that cash flow and buys back shares. So we really like that. Now, long term, I don't think you can go wrong with this. It's an industrial name. And what we like about it is it distributes industrial products such as power transmission components. We love that. That's one of the main reasons we just like this industry that it's in, as well as tools, bearings, safety products, etc. So mid-cap name out of Cleveland, Ohio. And it's not a fast grower, but it's a consistent business, consistent cash flows, great business. And I have no problem buying more of it. Now, the question is, do you buy more of it now? It's a bit overbought. We would like a pullback. Ideally, let me give you a number here. I would love to buy it around the 200-week moving average. Right now, that's around 170. That's going to go up over time. But call it, below 200 would be amazing. I would love to pick it up below 200. So that was AIT. Now let's squeeze in one more listener question now.
Hi, Luke and Justin. This is Matt from Minneapolis, longtime listener. I've been looking at some stocks that I feel people will always need, and that's food. I've been looking at KR Kroger and SFM, which I believe is Sprouts Family Market or Farmers Market. Would either of these ever be appealing to get into? And would the prices they're at be good? And what do you think about this area of the market to get into? Is this something to be in and hold for long term? Thank you for your thoughts. I appreciate it. Have a great day.
All right, looking at Kroger's and Sprouts Farmers Market. Now, Sprouts is certainly smaller, $13 billion market cap there, $40 billion for Kroger's. Now, we own Sprouts for managed accounts, and we've owned it for a long time. You're going to love this. We bought this around $20 per share. I think it was around COVID. I'm trying to remember the exact date. It's been so long since we bought it. We've just been buying and holding it. And now it's at $131 per share. The reason we bought it is because of secular trends. Sprouts is a company that sells more natural and organic foods, and younger generation, they want those type of foods. And there was a lot of runway for them for growth. They mainly were focused here in California, but now they're in 23 different states, 407 stores. They're opening more and more stores throughout the country, and they just have a model that is very appealing to the average consumer. And consumers are now they're spending more money at home. So I do like the idea of investing in supermarkets because people are going out less. It's more expensive to eat out than it is to eat at home. And you have more control over what's going in your body and your health there. So we much rather invest in companies that are focused on natural and organic foods. And so we would rather own Sprouts. We continue to hold it. It's a great company. It is a bit expensive at the current time. So, we've trimmed recently a little bit, but still we're holding, our significant position in Sprouts. And I'd much rather buy that for the long term. Thanks for the call. Well, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and calculate your risk number. All you have to do is head over to investtalk.com and click on the portfolio review button. This is free and it is confidential. This is InvestTalk, independent thinking, shared success. Good night.